Economists were expecting 1.5% annualized GDP growth in Q1. Statistics Canada delivered negative 0.5%. That is 2 consecutive quarters of annualized GDP decline. By the most common definition, Canada is officially now in a technical recession, the first since the 2020 pandemic. And that's where we're starting today. Welcome to the Daily Brief Canadian Macro. I'm Steve, and today is Friday, but instead of our regular manure meter episode, we're covering this morning's GDP release because it changes the conversation. StatsCan dropped the Q1 numbers this morning. The headline is a miss, a big one. Consensus was for 1.5% annualized growth. We got negative 0.1%, combined with a revised Q4 2025 figure that came in at negative 1%. That's 2 straight quarters of annualized contraction. Let's get into it. Technical recession by most widely used definition, but StatsCan calls this a mixed picture, and they're not wrong. On a quarter-over-quarter basis, Q1 was essentially flat. It's the annualization that pushes it negative. The 2 worst months were October and March, with growth flat or positive in between. This isn't an economy in free fall, but it is an economy that stalled. What dragged it down? Higher imports, up 2.9%, roughly half tied to gold, and weak resource extraction in March. What held it up? Business inventory accumulation and, on the surface, household spending. But that household spending number deserves a closer look. Nominal consumption, dollars spent, rose 0.9% in Q1, but disposable income only rose 0.6%. The gap was covered by Canadians drawing down savings. The household saving rate fell to 3.5%, the lowest since 2024. People aren't spending more because they have more. They're spending more because everything costs more, and they're dipping into savings to cover it. That's not consumer strength, that's a pressure gauge. There was one bright spot in the data. StatCan's advanced estimate for April is a 0.4% monthly rebound, led by mining and oil and gas. The harder context, 3 of the last 4 quarters are now negative, and Q4 2025 was revised down to minus 1.0%. The hole Canada is climbing out of is much deeper than we thought. Next up is business investment, and this is a number I want to spend time on because it doesn't get the attention it deserves. Business capital investment fell 0.7% in Q1 2026. That's the 5th consecutive quarterly decline. 5 quarters. That means Canadian businesses have been pulling back on investment continuously since early 2025. Not pausing, not holding, declining every single quarter for over a year. This connects directly to the productivity story we covered a few weeks ago. Canada was already running well below the OECD average on business investment per worker before the stretch began. 5 quarters of contraction doesn't fix that gap, it widens it. The causes aren't hard to find. Trade uncertainty with the U.S. has been the dominant factor. When you don't know what the tariff environment looks like in 6 months, you don't commit capital to new equipment or facilities. The CUSMA situation has put a ceiling on business confidence that shows up directly in the investment data. Government capital investment also fell in Q1, compounding the private sector pullback. Exports edged down 0.1%, weighed down by declining shipments of passenger cars and light trucks, a sector that's been directly hit by U.S. tariffs. Crude oil and natural gas exports partially offset that, but not enough. The April rebound estimate is driven by resources returning to growth. That's a volume story, not an investment story. The underlying capital formation trend doesn't reverse in just a month. For the structural view, if Canada's productivity problem is going to get solved, it runs straight through business investment. And right now, that number is moving in the wrong direction for the 5th quarter running. Last but not least, the Bank of Canada has held interest rates at 2.25% since late 2025. Its April forecast called for 1.2% full-year GDP growth. After this morning, that number is gone. You'd need an extraordinary second half to even get close. So what does the BOC do on June 10th? The problem is inflation. The bank has already upgraded its 2026 forecast to 2.3% average, with energy pressure from the Middle East. That's not a number that gives you a clean path to cutting. BMO Salvatore said it plainly ahead of today's release, on hold for the foreseeable future. But if the trade war causes further harm, the bank may need to cut. That threshold is now being tested. Recession on the left, above target inflation on the right. And we're stuck in the middle at 2.25%. What to watch on June 10th isn't just the rate decision, it's the language. Hold with the cut signal is a very different message than hold and stay neutral. This morning data narrows their room to say nothing. Looking at the big picture, Canada is in a technical recession, but the data underneath is more nuanced than the label. The contraction is concentrated, 2 bad months, specific sectors, with household spending holding up, and an April rebound in the advanced estimate. This is an economy potentially just stalled and not one that's broken yet. What's harder to miss is the investment picture. 5 straight quarters of business capital decline is a structural signal. Canadian businesses have been pulling back for over a year because committing capital in this trade environment feels like a bad bet. That's not a recession story. It's a productivity story, a competitiveness story, and it was true before today's numbers even arrived. The Bank of Canada now sits between a technical recession and above target inflation, the perfect recipe for stagflation, and with a rate decision just 12 days away. Bottom line, watch out for June 10th and watch the investment data keep moving, because that's the number that tells you where this economy is actually going. Well, that brings us to the end of our episode. Thanks for watching the Daily Brief. If you found this original content helpful, please subscribe, hit that notification bell so you don't miss our next brief, and don't hesitate to comment if there's a creator or topic you'd love to see covered here. I'm Steve, as always. Nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.